China returns tonight. $88 silver and 2 weeks of pressure. Waiting for 14 days, the Shanghai Exchange was silent, but the physical silver market was not. 253 million ounces of paper silver sitting on a clock. A single man's short position, larger than every ounce of silver on the entire exchange. Warehouses draining, deliveries accelerating, and a market that was slammed down repeatedly and kept coming back. Tonight, Shanghai opens, and what happens in the next few hours could change everything. Welcome to AO and AG, the one place where we don't chase headlines, we decode them. Now, before we go further, if you've been around long enough in life, and I mean really long enough, you know that the most important things are always the ones people aren't talking about loudly. So I'm going to ask you something. The same way you'd ask a wise friend who's seen a few market cycles, a few currency collapses, and a few moments where the world shifted quietly before anyone noticed. Hit that subscribe button. Not because everyone else is doing it, but because you're the kind of person who wants to see what's coming before it arrives. This channel is built for that person. And one more thing, drop a comment below and tell us, where in the world are you watching from tonight? Because tonight, geography matters. For 14 days, the lights were off in Shanghai. The Lunar New Year holiday had pulled China's Futures Exchange into silence. No bids, no offers, no price discovery from the world's second largest economy. For 2 full weeks, the silver market ran on one engine instead of two. And yet, something unusual happened during that silence. Silver didn't collapse, it fought. Every single day that Shanghai was dark, the Western markets were active. Traders pushed prices down, repeatedly, aggressively. On the day this story was recorded, silver was knocked back to an $85 handle. Not once, but multiple times. Each time the market looked like it was about to break. Each time buyers came back in. Quietly, steadily, without announcement. By the time the dust settled, silver had reclaimed $88.50 on Western spot. To the untrained eye, that looks like normal price movement. Numbers going up and down on a screen. Nothing unusual, nothing alarming. But to anyone who understands how markets actually work, that pattern tells a very specific story. When a price is pushed down repeatedly and repeatedly refuses to stay down, it means something is holding it up from underneath. Not hope, not sentiment, not optimism. Real bids, real buyers. Entities willing to absorb the selling pressure and keep coming back for more. That is not the behavior of a weak market. That is the behavior of a market where someone or something does not want silver to go lower. Meanwhile, the numbers around silver were quietly becoming historic. Gold was sitting at $5,728 in Western spot. 2 trading days earlier, both metals were meaningfully lower. Over those 2 sessions, gold had climbed roughly 4% and silver had climbed over 11%. In the same window, Bitcoin fell. That divergence matters. It is not random. It is a signal. Capital was moving, not in a panic, not in a frenzy, but deliberately, methodically, away from speculative assets and towards something with weight, something physical, something that cannot be printed, duplicated, or deleted. And all of this happened while Shanghai slept. Tonight, Shanghai wakes up. 2 weeks of pressure, 2 weeks of physical drain, 2 weeks of a market holding itself together under repeated attack. The question every serious market observer is now asking is simple. What happens when China opens its eyes? There's a number that does not make headlines. It does not trend on social media, and it does not get discussed on mainstream financial television. But for anyone who understands the architecture of commodity markets, this number is everything. 223 million ounces. That is the amount of paper silver sitting in the COMEX futures market just 3 trading days before what is known as first notice day. The moment when holders of futures contracts must declare whether they intend to take physical delivery of the metal they have been trading on paper. To put that into perspective, 223 million ounces is not a rounding error. It is not a routine position. It is a mountain of paper promises sitting on top of a physical market that has been bleeding inventory for months. Now here is where the story becomes important for anyone who believes markets always settle cleanly and quietly. Most of those contracts will roll over or close without ever touching a single physical ounce. That is how paper markets are designed to function. And for decades, that system has worked because the assumption underneath it was always the same, that physical silver would be available when needed. That assumption is now under serious pressure. On a single Friday, 2.25 million ounces were drained from COMEX silver warehouses in one day. Not one warehouse, multiple warehouses simultaneously. C&T, Delaware, HSBC, and JP Morgan all recorded withdrawals on the same session. Total COMEX silver inventory now sits at 364 million ounces, and the drain is not slowing down, it is accelerating. February silver deliveries through COMEX have already reached 23.5 million ounces in a single month, meaning the pipeline between paper promises and physical metal is not theoretical anymore. It is active, and it is moving fast. And then there's the volatility signal that most people walked right past. Silver's COMEX implied volatility index broke above 100. Again, think of this number the way you would think of a pressure gauge on a pipe. When it reads low, the system is calm, and when it spikes this high, the structure underneath is telling you something is wrong. It does not tell you which direction the pressure releases. It only tells you that the release, when it comes, will not be gentle. The physical floor is real. The paper mountain sitting above it is beginning to feel its own weight. There are moments in financial history where a single position becomes so large, so structurally dangerous, that it stops being a trade and becomes a crisis waiting for a date on the calendar. This is one of those moments. His name is linked to a position that has quietly become one of the most closely watched situations in the global silver market. He is a Chinese billionaire, and his short position on the Shanghai Futures Exchange sits at 450 metric tons of silver. That number alone would be remarkable in any market environment. But here is what transforms it from remarkable into something far more serious. The total physical silver inventory sitting inside the Shanghai Futures Exchange at this moment is approximately 350 metric tons, which means this one man's short position is larger than every single ounce of physical silver that the exchange actually holds. He has sold silver he does not have against a stockpile that cannot cover him. In the world of commodity trading, this is not just aggressive positioning. This is a structural impossibility dressed in financial clothing, and it has been allowed to exist long enough that unwinding it cleanly may no longer be an option. Regulators have not been silent. They have frozen his ability to add new positions, and they have raised margin requirements specifically targeting the pressure this trade is creating. But raising margins on a position this size does not eliminate the problem. It only makes the clock louder. The question that serious market observers are now asking is not whether this position is dangerous. That question has already been answered. The question is how it ends. In theory, a position like this can be hedged, paper offset against paper in another market. But at 450 metric tons with no physical buffer and cross-exchange capital requirements tightening simultaneously, the exit path is not clean, and every hour that passes without resolution is an hour where the pressure builds further underneath the price. And then Shanghai closed for Lunar New Year. For 2 full weeks, this position sat frozen in time while Western markets moved. Physical inventory drained, and delivery demand accelerated on the other side of the world. Tonight, the Shanghai Futures Exchange reopens for the first time since that holiday began. That billionaire's position does not get another 2 weeks of silence. The market is open. The clock is no longer ticking quietly. Every market crisis has 2 layers. The first layer is what happens on the screen. The numbers, the positions, the paper contracts moving between institutions at the speed of a keystroke. The second layer is what happens in the ground, in the mines, in the mountains, in the supply chains that move physical metal from the earth to the exchange warehouses that the paper market depends on. Right now, both layers are under pressure simultaneously. And the second layer, the one that most analysts are not discussing loudly enough, may be the more consequential of the two. Begin with a fact that reframes the entire silver supply conversation. Global silver production peaked in 2016. Not last year, not recently, in 2016. And the world is not expected to return to that level of output until sometime around 2030. That is a 14-year window where the supply side of the silver equation has been structurally constrained, while the demand side has done the opposite of constrain itself. Industrial demand for silver has grown from 47% of total consumption to 67% in recent years. Solar panels, electric vehicles, data centers, defense systems, advanced electronics. Every sector that defines the direction of the modern economy runs on silver, and every sector on that list is expanding simultaneously. The market has run deficits for 5 consecutive years. 5 years where the world consumed more silver than it produced. And the paper price has not reflected that reality in any meaningful way. Until now. Then there is Mexico. Mexico supplies between 45 and 50% of all silver imported into the United States, and Mexico right now is not stable. A criminal organization known as El Ro has effectively seized control of key transit corridors in silver-producing regions. Roads are blocked, mine operators are halting production, and cartels are actively extorting shipments before they can reach their destinations. This is not speculation. These are documented operational disruptions in the supply chain of the metal that underwrites a significant portion of American industrial production. And then the situation escalated further. The President of the United States publicly stated that if Mexico wanted help dealing with its cartel problem, the United States would be, in his exact words, honored to go in and do it. That is not diplomatic language. That is a signal that the situation on the ground has reached a level where military intervention is being discussed openly at the highest levels of government. For a nation that produces 1 in every 4 ounces of silver mined globally, that level of instability is not a footnote. It is a supply input risk of historic proportions, and the paper market has not priced a single ounce of it. There are moments in markets where the noise becomes so loud that most people stop listening carefully, and then there are moments where, if you filter out the noise completely and watch only where capital is actually moving, the signal becomes so clear it is almost uncomfortable to look at directly. This is one of those moments. On the same day that silver was being knocked back repeatedly to an $85 handle and recovering every single time, something extraordinary was happening in parallel across multiple asset classes. Simultaneously, gold added over $500 billion to its market cap in a single hour. Not a single trading session, not a single day, a single hour. Silver added approximately $130 billion in that same window. Now place those two numbers next to what was happening everywhere else at the exact same moment. Bitcoin fell below $64,000 as leveraged positions were forcibly liquidated across crypto exchanges. Cybersecurity stocks lost over $52 billion in combined market value across just 2 trading sessions. CrowdStrike fell 20%. Cloudflare dropped over 18%. IBM fell 10% in a single session. These were not small sector corrections driven by company-specific news. These were coordinated capital exits from entire categories of assets that carry what sophisticated investors call counterparty risk. The risk that the value of what you hold depends entirely on someone else's ability to perform. And the capital that left those assets did not disappear. It moved. It moved deliberately and measurably into gold and silver, assets that have existed as stores of value for thousands of years precisely because they do not require anyone else to perform. They do not require a balance sheet to back them, and they cannot be diluted by a central bank decision made on a Tuesday afternoon. But perhaps the most significant capital movement signal in this entire picture is not coming from Western markets at all. It is coming from China. Chinese gold ETF holdings rose 52% between late August 2025 and the end of January 2026. The World Gold Council described the pace of that accumulation as historic. This is not retail enthusiasm. This is institutional and retail capital inside the world's second largest economy, making a coordinated and sustained decision to move into hard assets during a period of elevated geopolitical uncertainty and domestic economic pressure. When the second largest economy on Earth moves this decisively in one direction, the rest of the world eventually follows. The smart money is not predicting the storm. It is already inside the shelter. There's a conversation happening at the highest levels of economic policy right now that almost never makes it into the silver market discussion. And that is precisely why it matters here. Most people who follow precious metals think about inflation, interest rates, central bank policy, geopolitical tension. These are the traditional forces that drive capital into hard assets, and they are all present and active in this current environment. But there is a newer force, quieter, more structural, and potentially more consequential than any of the traditional drivers. It is artificial intelligence, and not in the way most people are thinking about it. The conversation around AI and financial media is almost entirely focused on which companies will benefit, which stocks will rise, which sectors will be transformed into engines of productivity and profit. That conversation is real, but it is incomplete. Because the other side of that transformation, the side that does not get discussed in earnings calls or technology conferences, is what happens to the 50% of the American workforce classified as white-collar cognitive workers when the tools that replace their most valuable tasks become cheaper than their salaries. Consider what happened on a single day in this story. Anthropic launched Claude Code, an AI system capable of converting legacy software code directly and automatically. And within 2 trading sessions, the cybersecurity and legacy technology sectors lost over $52 billion in combined market value. That was not a market overreaction. That was institutional capital, doing the math in real time. If AI can now perform software modernization, security analysis, code conversion, and cognitive task execution at a fraction of the human cost, then the business case for maintaining large teams of high-income cognitive workers begins to deteriorate faster than any retraining program can compensate for. And here is why that connects directly to silver and gold. The top 20% of income earners in the United States drive over 60% of total consumer spending. If AI-driven displacement compresses wages at the top of the income distribution faster than new high-income roles are created, the feedback loop that follows moves through housing, consumer credit, tax revenue, and government deficit financing simultaneously. Every one of those pressure points lands on the dollar, and every pound of pressure on the dollar is a pound of structural support underneath hard assets that cannot be printed, cannot be automated, and cannot be replaced by a more efficient algorithm. The displacement loop is not a future risk. It is a present reality that capital is already pricing in quietly, and silver is sitting directly in the path of that reallocation. Every story has a side that is easy to tell the side with momentum behind it, the side where the data points a line, the side where each new piece of information seems to confirm what came before it. This story has that side, and it has been told carefully across the previous 6 parts. But there is another side, and any serious analyst, any genuine student of markets, any person who has watched cycles long enough to understand that conviction without caution is not intelligence, but arrogance, knows that the other side must be told with equal precision. So here it is. The same implied volatility spike that signals structural stress in the silver market does not point exclusively upward. When the COMEX Silver Implied Volatility Index breaks above 100, it is telling the market that violent moves are being priced in ahead. Violent moves in either direction. A coordinated response from large institutional players who have the balance sheet to absorb short-term pain and the patience to wait out a squeeze. A sudden liquidity event in another asset class that forces rapid position unwinding across commodity markets. A policy decision from a central bank or regulatory body that changes the cost structure of holding physical positions overnight. Any one of these forces could push silver sharply lower in the short term, even if every single structural argument made in this story remains completely intact. The Shanghai reopening tonight carries its own uncertainty. 2 weeks of price movement happened while Chinese institutions were absent from the market. When sophisticated institutional traders return from an extended absence to find a significant price gap waiting for them, their first instinct is rarely to chase the gap aggressively. It is to assess, to measure, to be deliberate. If Chinese institutions decide that measured caution is the appropriate response to the gap that formed during their holiday absence, the explosive confirmation that the physical market seems to be pricing in may not arrive on the schedule that momentum traders are expecting. Then there is Mexico. The situation on the ground is real, and the geopolitical escalation is documented, and the supply chain risk is genuinely significant. But risk is not the same as confirmed disruption. The mine halts and road blockages have not yet shown up as verified reductions in actual silver output data. The risk exists clearly on paper. The confirmed supply impact does not yet exist in the numbers. And finally, there's the principle that Mark Douglas spent his career trying to teach serious traders. Even the strongest setup, even the most thoroughly researched position, even the most structurally sound thesis in the most favorable macro environment the market has seen in a generation can still lose on any given trade. The edge in markets is never about being right on a single moment. It is about playing well-researched probabilities over time with discipline that does not break when the unexpected arrives. Caution is not weakness here. It is the final piece of intelligence that separates serious market thinking from expensive enthusiasm. There are rare moments in financial history where multiple forces that normally operate in isolation from one another begin moving in the same direction at the same time. Not because anyone planned it, not because a single actor engineered it, but because the underlying structural pressures that had been building separately for months, for years, for in some cases an entire decade, finally reach a point where they can no longer remain separate. They converge. And when they converge in a market as small and as physically constrained as silver, the mathematics of what follows become very difficult to ignore. Consider what has been documented carefully across every part of this story. A physical market, running deficits for 5 consecutive years, with peak production still years away from recovery, and industrial demand consuming a larger share of every ounce mined than at any point in modern history. A paper market carrying 223 million ounces of open interest 3 days before first notice day, while warehouse inventory drains accelerate across every major COMEX depository simultaneously. A single short position on the Shanghai Futures Exchange, larger than the entire physical inventory of the exchange itself, held by one man with no clean exit and a clock that just restarted tonight. A supply chain in Mexico, the source of nearly half of all American silver imports, destabilized by criminal organizations to the point where the United States government is openly discussing military intervention. A macro environment defined by tariff escalation, AI-driven labor displacement, capital rotating out of equities and cryptocurrency and into hard assets at a pace the World Gold Council is describing as historic. and a gold to silver ratio that compressed from 100 to 1 all the way down to 44 to 1 when silver briefly touched $120 and is now stabilizing in the 60s, telling anyone paying attention that something fundamental has shifted in how these two metals move relative to each other. Every single one of these forces is pointing in the same direction. Not one of them is theoretical. Every data point in this story is documented, verifiable, and publicly available through the CME reports, the World Gold Council data, and the Silver Institute supply-demand figures. The open question has never been whether the structural case is sound, or the open question is timing. And tonight, for the first time in 2 weeks, the market that holds the most immediate answer to that question has reopened its doors. Shanghai is open. The pressure that spent 2 weeks building in silence now has somewhere to go. What happens next will not be decided by analysts or commentators or content creators. It will be decided by the market itself, in real time, in the hours ahead. Watch closely. Verify everything. And remember that in moments of genuine structural convergence, the most expensive thing a serious person can afford to be is distracted.